Last year was a record-setting year for exchange-traded funds, also known as ETFs, with inflows hitting all-time highs, and they outperformed mutual funds for the third straight year. Mutual funds and ETFs are similar, but also have some key differences that may make one a better investment for you than the other. So what are ETFs, and how are they different than mutual funds? Let's find out. An ETF is an investment fund that is made up of a mix of assets that include things like stocks, bonds, commodities, and they track a specific index, or it can specialize in a specific industrial sector. Unlike a mutual fund, an ETF is traded like a common stock on an exchange. An ETF experiences price changes throughout the day and can be bought and sold at any time at its current price when markets are open. A mutual fund can only be bought or sold at its closing price at the end of the day. Because they're traded on an exchange, ETFs must be bought from a broker. That could be a physical person or an online brokerage you use trading your mobile device or computer. Another key difference between an ETF and a mutual fund is that an ETF has no minimum investment threshold. To join the investor pool of a mutual fund, you may need to invest a minimum amount. For an ETF, as long as you have enough money to buy one unit, you can invest, and you can buy as many or as few units as you choose. The last key difference between mutual funds and ETFs we want to highlight is their fees. ETFs typically have lower fees than mutual funds because they trace an index, do not require the same daily management that a mutual fund does. ETFs still do have fees and risks though, which should be reviewed thoroughly before any purchases. And that's some basics on ETFs. To learn more about ETFs and other basic investing topics, visit our website and follow us on our social media channels to learn more about basic investing.